Hey traders, welcome to the Raghee Report. Happy Sunday, everyone. Hope everyone's had a good weekend, a little time away from the charts, ready to get back to it. And we got a lot to look at for today's show. Ultimately, when we are looking at opportunities, and I'm going to pull up a window here. We were looking at opportunities. So much of it has to do with timing. And here in the Raghee Report, one of the things that we'll do is always make sure we head on back over to the calendar. And if you've never been to Forex Factory, it's simply forexfactory.com. Click the calendar and it will take you to this link. And today, or at latest tomorrow morning, please, please, please scroll through and just pay attention to where these little red icons are. Those are the hot zones, the red hot zones. And the first one we're going to see, we have a couple for the RBA, which really isn't a major hot zone for us here in the States. ECB would be, but RBA, Reserve Bank of Australia, not so much. But take a look here. Fed Chair Powell testifies. And it's the Humphrey Hawkins testimony. I know they don't call it that anymore, but that's what it is. And that means we're right back to hearing about what it is that the central bank is most interested in terms of whatever they want to communicate regarding monetary policy, what they think they've done. They're never going to point out. The only negative we're ever going to hear are there's still headwinds. We still have more to go. They're never critical on their own performance. Not that I'm expecting them to be. But remember, that's a 2-day extravaganza. And in between all that, we've got ADP non-farm payroll on Wednesday, JOLTS job openings on Wednesday. And then, of course, we have some more FOMC speak, all leading up to, you guessed it, a March 10 average hourly earnings, unemployment rate, and of course, the non-farm change. That's on Friday. So we have a very, very active week. Not only do we have massive macroeconomic data by way of the jobs number, we have macro man himself, Jerome Powell. So that's the week, gang. Unless there's some dramatic unforeseen event, maybe geopolitical in nature, that is the week. That is what we're all going to be gearing up for. What is Powell going to say on Tuesday, the 7th, and Wednesday, the 8th, and then Friday? And as we go into those events, and again, if you haven't seen, on the 8th, and I'm sure we'll have some interesting charts as well from the next couple of days, at least I'm hoping to, we're going to have another discussion about 1-hour charts, daily price movement ranges, the toolkit around how we can focus on structure, and slightly longer term trends, our short-term swing trades. So we're going to talk about that on the 8th at 8 Eastern. All right. So super stoked for that. And I know a lot of you already have the tools. You're already, looking at the DPMR. So this second webinar is going to give you a little bit more insight as I share more about what I'm doing with these. It's going to give you a little bit more insight into these tools as we go into this coming Saturday, the 11th. We have our class coming up. So super stoked about that. All right. So let's jump on into the questions. And first up is Mark. How you doing? The JT Multi rapidly shows how healthy a stock is. Absolutely. When we talk about, let's do this here for a second. I would seldom make the subchart the star of the show, but it sure does help sometimes to sort of exaggerate the importance of a certain section on the chart. And if you take a look here, let me grab my drawing tools. This thing right here, these two rows of colors, this top row and this, I wanted to grab a framing tool. There we go. This top row and this bottom row of colors, that is the multi-trend. Absolutely. That multi-trend helps us understand two things. One is the top row is Momo. The bottom row is trend. And we use a total of 4 exponential moving averages and the way that they interact with one another to determine if we have bullish, neutral or bearish trend, bullish, neutral, or bearish momentum. And momentum typically precedes trend, not always, but if we're going to see a shift in trend, oftentimes there might be a clue if we have a lingering, persistent momentum read, but not always. And it's good to be able to differentiate bearish momentum from a neutral trend, because a lot of times when the momentum gets bearish, traders who don't differentiate the strength of one versus the other can sometimes think, oh, this is a bearish market, when in reality, it's just bearish sentiment, bearish momentum within an overall trend. And there is a huge difference. Absolutely. So that's what it is that Mark's mentioning. How did I get the idea to create? Oh, gosh, Mark, I got to give kudos to, well, first of all, the process is something I've done for a very long time, looking at the 8, 13, 21, and 34 exponential moving averages. They were the propulsion. I believe John does something similar. And one of my members said, Rod, I can automate this. You talk about the structure of these moving averages. I can automate what your process is. And that's the same thing we do with HPMRs. It's the same thing we do with DPMRs. It's just an automation of the process. And so I just use these two, makes it really, really easy. We put the 8, 13, 21 in the top, and the 34, we separate it. That's what makes us so different, right? We separate it, momentum and trend. And it's traffic light simple. So yeah, the process was something I've been doing for a long time, but I got to give kudos to one of our members who said, you know what, I think we can code this. And I think Bot, you've changed some of the code over the years as well, I believe. But yep, that's what it is. That's what it is. So it's a process that is very old school. Mark, the process is of using moving averages, simple or exponential, to understand the underlying market structure, which, by the way, is the first step before we use any tool like an HPMR or the DPMR. That's why there's always a toolkit. That's why there's always a sequence that accompanies any indicator. Any indicator on its own is only as good as our ability to apply it to the market's current mood. Yeah. And that's the way that I've always looked at that. All right. Okay. Next up is, do I have anything that leads? Nick, I don't believe in leading and lagging indicators. And the reason for that is simply, if it needs price, it cannot lead price. It's just that simple. If it needs price, it cannot lead price. And I know it's a very sexy type of idea that we could cook up some indicator that tells us what price is going to do. And yet when you look into the guts of the indicator, what it's using, it's going to have some number crunching of open, high, low, close, right? So if it needs price, how could it lead price? That's my thinking. However, all is not lost. Rather than leading, I think about projecting. Do I have anything that can project possibilities, right? Because leading almost sounds as if the market is a dog and we can find the walker, and that decodes, if we can find the dog walker, that decodes all the mysteries of the universe for us. I wish it were that simple, right? We know there are certain generalities that will help any kind of market. We know that cheap money and low yields help stocks, and lower bond yields and weaken the US dollar. We know there's certain things that push and pull each other, but in my mind, I always want to think about high probability projecting, right? Sometimes that can be a Darvis. Sometimes that can be the wave, right? I'm projecting where there could be a mean reversion. And other times it's going to be, as you can see here, the envelope of the upper and lower ranges of the DPMR and the HPMR, right? HPMR for day trading, DPMR for short-term swings. So I don't have anything that leads. I don't believe there's such a thing, right? Although a lot of folks like to think they found such a thing. But like I said, if it needs price, it can't lead price. And so think about high probability projections. Where could something go, right? That's part one. And what do I want to do when it gets there? That's my take. So I appreciate the question. All right. Next up, I see that the euro, gold, and bonds kind of move in similar directions. Does it seem that one leads the other? No. What leads them all, though, Nick? So let's go back to what would cause the euro to move, the dollar to move, and gold to move, and and bonds to move. Macroeconomic, macro and monetary policy. So macroeconomics is simply the study of what we think is important to the Federal Reserve. We can give it all sorts of fancy names, but at the end of the day, macro is what do Powell and company care about? Jobs, inflation, growth. All right, so we're studying jobs, inflation, growth. That's macroeconomic. Then the monetary policy is going to reflect their take on those things, jobs, inflation, growth. If monetary policy favors higher rates, that is going to be the first domino, right? Higher rates means dollar is stronger, euro is weaker. Gold, depending upon the rate of inflation versus the yield of a bond, could move higher based on that real interest rate. And then finally, bonds themselves are going to mimic what it is we think monetary policy is going to do, increase rates or decrease rates. So it's not that they're affecting one another per se, although the euro and the US dollar do affect one another. If euro is strong, dollar is weak. But why would the euro be strong? Or why would the dollar be strong? It goes right back to the European Central Bank and monetary policy, or the Federal Reserve and monetary policy. So they share a common catalyst for movement. It's not that they move each other necessarily, although bonds and gold do have a certain synergy based on real interest rates, and euro and US dollar are the biggest market in the world. When one's weak, the other's strong, and vice versa. So, but the reason all of those things move, right, is monetary policy. All right. Next up is, can we use the 1 hour? Let's see, can we use the 1 hour So John, let me clear a few things up here. So there's no such thing as a 1 hour HPMR any more than there's a 5-minute HPMR or a daily DPMR. They simply are hourly price movement ranges, and they are daily price movement ranges. But I think I understand where you're coming from. So the hourly price movement range can be used in a 5-minute time frame, a 2-minute time frame, a 30-minute, 15, 1 hour. You can use it on whatever you'd like, right? But no, they are not interchangeable, John. The simple answer is they're not. And let me explain why, right? And we're going to talk about this a lot on Wednesday, because I think there's a lot of folks saying, Rag, I have HPMRs. And if I may say so without making too much of an assumption, the idea is, Rag, I already have this HPMR thing. Doesn't it do the same thing as a DPMR? So the way that I describe it is a simple no, but here's why it's not the same. All right. And I think it's a really great question. Like I said, we'll get into it more on Wednesday, but think of it this way. An hourly price movement range uses 60-minute high-low ranges, right? So it's breaking down historical volatility in 60-minute chunks. What's the behavior of a market over the course of the 60-minute chunks throughout the year, or throughout the day. DPMRs, right, are breaking down the day into daily or session chunks, one full day. So it's looking at the behavior on 6 months of Mondays, 6 months of Tuesdays, 6 months of Wednesdays, as opposed to the HPMRs that is looking at 6 months of 9 to 10 a.m. Eastern and 6 months of 10 to 11 a.m. Eastern. And it's breaking it down in those particular groups or chunks, if you will. So the amount of price movement we'll see over the course of an hour is obviously much less than the amount of price movement that we could see over the course of an entire session. So the zones themselves are completely different. So I can totally appreciate, hey, Rag, I have these HPMRs. Can't I just put them on a daily time frame? Well, you know what? That's a fair question. And like I said, we'll dive into it more, but let's do a little bit of that right now. I've got the daily time frame on the left, on the right. Sorry, the daily's on the right, and the 5-minute is on the left. All right. So first of all, they're at complete, and this is both the 6E, but you know what? Let's pull up the S&P right now. It's open. It's moving. All right. Take a look at the S&P ranges. The upper edge is what, 4108.5 to 4136.5. Now, also, we have standard deviations above and below the daily price movement range. That's what's on the right. Let's go take a look at the resistance on the HPMR. So again, if you want to jot that down, 4108 to 4138, roughly that. The HPMR zone is 4052 to 4058. It's completely different, right? It's completely different. Let's do one other thing. So I know, okay, Rag, I get that, but can we see what it looks like with the HPMR on there? And oh, you know what? Let me just do this. Let's change this 5-minute chart to a daily. I'm really messing up my charts here, but I hope it makes the point. And I don't even know, bot, can I even do that? Will it pop up if I even do that? It may not. Right. So I just want to show you all, if they're completely different, they're completely different levels. So if you're thinking, well, they're plotting the same levels, but on a different time frame. Yeah, not at all. So let me just, and again, we're going to dive into Q&A on that. Toss won't do it. TradingView will attempt it. TradingView will say, okay, if that's where you want the price movement ranges, but remember, you can plot it on kind of whatever you'd like, right? But please remember, look at the difference in the zones, because one is studying 60-minute behavior, the other is studying an entire session. So the way I like to describe it is, if you have a 20-period simple moving average and a 200-period simple moving average on the same chart, do they plot in the same spot? And we know they don't. It's not any different. So HPMRs are for day trading and DPMRs are for short-term swings. And that is what tends to work better. Now, if you want to lengthen the time frame you're using on an HPMR, you sure could, but you're still studying hourly behavior, right? As opposed to daily behavior. And the idea now is, yeah, we can keep day trading, although a lot of folks are telling me, wrong, I'm not day trading as much anymore. Got to go back to work. You know, my schedule's back to the way that it was pre-2020. I don't have the access for an hour or 2 hours of active trading. And let's face it, a lot of folks don't like it. A lot of traders have told me, Rog, I need to have a slower way to trade the market. I can't be looking at the market on a 2, 5, 10, 15-minute time frame. I need to slow things down. And the easiest way to slow things down is to lengthen the time frame. The way that I'm finding lengthening the time frame is working is looking at 1 hour time frames, minimal, whether that be 1, 2, 4. I'm using the 1 hour right now. We've tested that for 10 months. The daily price movement range also works in the daily time frame. And that again slows things down. So we're not having to watch 5-minute intervals. Instead, we could slow it down to an hour or even a day. So completely different. John, I hope that makes sense. I think a lot of folks are hoping that, hey, Rod, aren't just these DPMRs just HPMRs on a daily chart or a 1 hour, and they simply are not. Now, if you want to try the HPMRs on a longer term time frame, go for it. But again, the nature of what you're studying is 60-minute volatility as opposed to an entire session's volatility. And that is going to put very different levels on your chart. They're both useful, but they're useful for different reasons, for different time horizons. So I appreciate the question. Like I said, we're going to jump into a lot of that and a lot more Q&A on Wednesday. So I hope that's something everyone has time to come check out live, because I'm really looking forward to, answering questions like John's before we get into the class on Saturday. All right, let's see here. Mr. Walker says, check to see if your like button is working properly. That's fantastic, Mr. Walker. Thank you. All right. Next up is GLD. So let's jump into GC. GLD is neutral, but the slow stow points up on the daily. Pullback has been long, but prior trend is up. Okay, let's break it down. Yeah, let's look at the 1 hour chart of GC and the daily chart of GC. Now, notice I went to GC, not because I don't like the idea of GLD, but please remember, again, this is something that I consistently emphasize, and I hope it's starting to make a lot of sense, which is we can look at GLD, which is a 9:30 to 4 world, right? Very much moving as ETFs and stocks would. And then we can look at the GC, which is much more of a 24-hour type market. In other words, it's much more reflecting global opinion of gold. It's more complete data. And if I have more complete data, my indicators are going to work better. My price action is going to be more complete. I'm seeing the whole picture, right? But I can still take the idea that I see out of GC to GC options or GLD options, or heck, even the micro gold futures contract. So we have a neutral chart of gold above the 200 propulsion. We're in the bullish hemisphere, gang. We've been neutral since the first week of February. But if someone were to ask me, okay, Rag, what can I do? Should I go with a 1 hour or daily time frame of gold? I would say go with the 1 hour. We actually have an uptrend there now. And while I would be completely open to buying the daily price movement range, right? I'd be completely fine with buying the daily price movement range, which is, when you look at these, this range is the same as this range. It's the same range on those two time frames. However, the structure of the 1 hour also tells me I might be able to focus in on a mean reversion to the wave. So I have another opportunity on the hourly that I don't have on the daily. Now, the daily gave us an opportunity too. The daily already gave us an opportunity here with a neutral environment, a sector slow dose signal. You can see that right down in there in a neutral environment off the propulsion. Neutral, check. Signal, check. Support level, check. Right? So each of them gave us a different opportunity. I didn't have that opportunity on the 1 hour, and I don't have the mean reversion opportunity on the daily. So when you look at those two time frames with the DPMR toolkit and the DPMRs, you can say additionally, I have an hourly uptrend. Mean reversions are allowable. I have a choppy market on the gold daily, but again, there are zones that are viable here, namely the zone between, call it 18. Let's see, what do we have here? 1843 to 1833, right? That's going to be a zone that I can keep an eye going forward. So that's the way we would do it. All right. That's the way we would do that. And then that way you can see the different opportunities with the different time horizons. Now, when we get into the class on March, I'll talk a lot more about days to expiration on a 1 hour versus days to expiration on a daily. We'll talk a lot more about market structure and how I've got two different opportunities on the 1 hour where I only have one opportunity on the daily. So those things become more understandable once we go through that process with the toolkit. But that's what I've got here, Mark, just to give you an idea. All right, next up, Mr. Walker asks, does the previous day's close have a significance to my day trading? Yes, Mr. Walker, I call it the line in the sand. And the previous, in this case, when we get into Monday's session, and I'm in the Sector Secrets room with you all. And for those of you that did not know, and this is something I think it's really important for me to mention to existing and new members. If you take the class, you're going to be with me for anywhere from 1 month to 3 months. That's depending on which class you get. If you're a member, one of the things we've done very recently, in case you didn't know, is that on top of the 1 hour every morning of day trading, we're adding another session right on its heels of swing trading. So every day we start the day with some day trades where I have anywhere from 2 to 5 day trades that fire off every single morning. Last week on the alerts we sent the group, in my notes, we had our first loss was on Friday. Last week was a really great week for day trading, and we continue to set up our swing trades right after that session was over. So every day we start the day with day trading and then move on to our short-term swings. And so absolutely. We had one loser last week on the day trades. That's a bit of an anomaly of a week, but it was a great week. So the thing that I want to mention is, yeah, when I get in the Sector Secrets room tomorrow at 9:20, we're going to look at the previous session close and say, all right, are we above or below it? That's the line in the sand. Yeah, absolutely. Nick, that made sense on probability and predicting levels. Oh gosh, Nick, I appreciate that. Nick, I got to give you a lot of credit. A lot of people don't want to hear it. They really don't want to hear it. They heard someone say XYZ is a leading indicator, and that's it. Off to find the holy grail they go. So Nick, thank you for hearing me out. And thank you for understanding that nothing sees the future. I love it. Thank you, Nick. I think you made my day. Thank you. Thank you. All right. Dark matter and battle rap. Thank you so much. I asked you about MOS last week and it's done well. Oh, it has? You took a piece of that one? I don't. So you grabbed a little bit of that? Did you? So yeah, congrats on a nice trade. I don't think I had anything to do with it, but yeah, thank you so much for being here and for the question. Sandeep asked, do I use fib retracements? If so, which levels do I look at? Yeah, I do like Fibonacci. Sandeep, they're Pingala. That's what they are. We don't call them Fibonacci in my room. They are Pingala. And I look mostly at a 50%. I like to look at the high-low, preferably say I have a Darvis, preferably with the minor high-low tool that's part of the Darvis 3.0. And I will look at the last major move. So for example, if I were going to pull a level here, I might look from a minor high to a minor low. And you see I highlight the 50. That's my favorite. That's the Pingala. And then 382, 618, I'll kind of keep in the background. But my favorite's a 50%. I don't get too fancy with that. I will say, straight up, Fibonacci work is not a big part of my trading. I like the levels of expansion and contraction that is part of these numbers, the series of numbers, which is really the way in which nature contracts and expands. I mean, that's all that it really is. But it's that 50% that's my favorite. Yeah, by far. It's quick, it's accurate, it's easy. Yeah, I'm a fan. All right, Sri asks, thank you for the continuous commitment to spend time with us on my Sundays. It's my pleasure. Thank you for being here. Are you kidding me? Thank you for showing up on a Sunday. I'm going to be here anyways, building watch lists. Lorna and I are expanding yet again our daily price movement range list of symbols. So for those of you that like to day trade, you know already that our hourly price movement range is somewhere north of 80 symbols or 70 symbols, I think. Our daily price movement range, I think, is over 100. And so we are expanding those packs to have more high beta liquid names at the option chain that we can short-term swing trade. So no, my pleasure. Yeah, Lauren and I were going back and forth and she got those DPMRs updated. Yeah, she got those DPMRs updated. All right. So next up is, let's see, are we out of questions? I think we are. Excellent. All right. So let's go ahead and wrap up there. I will see you all tomorrow, same time, same station for charts and coffee. All right, gang. So tonight, if you have a moment, go spend some time at forexfactory.com. Scan through, see who's speaking. None more important than Tuesday and Wednesday's Powell events. Remember, non-farm payroll culminates in the biggest macro release, at least of this week. And then from a data perspective, and then remember, ultimately, what we want to do is ask ourselves, do we want to day trade and stay very, very nimble, say 5-minute timeframes, or do we want to stretch the timeframes out, look at, say, the daily timeframes and ask ourselves, if Powell moves the market, might we get some moves into the DPMR that we could take advantage of using that larger volatility zone? And that's definitely something we'll talk a lot more about. So again, if you haven't had a chance yet, feel free. I'll see you on March 8 at 8, simplertrading.com/clear. All right, gang. Be good to each other. I'll talk with you soon.